Okay, I think we're back now. So we're going to pick back up with where we left off. So we were looking at the um, June 12th transaction, the return of merchandise, defective merchandise, or damaged merchandise totaling $300. Right, so we discussed reducing accounts payable because that inventory wouldn't be paid for. And so what's being returned? Well, inventory is being returned. So that's our credit. Right? We've got the debit to payable, which is a liability, reducing that amount, and um, credit to inventory, which is an asset, thus reducing the inventory asset account. All right. Um, and that's the June 12th transaction. The last transaction we have is June 19th. Alright. Now, on June 19th, Tunes and Company pays Epps in full less the purchase discount. Alright. So, one potential trap here is we think payment in full, so we're going to look back to the purchase transaction. And if we were to pay the $8,000, we'd lose some points here because it's not actually the $8,000 that's owed. It's going to be less than that. Right? So what I'm going to do is set up a T account. And this may be something you find helpful to keep track of payables in problems. So we see the credit to payables for $3,000. And then we'll have the debit to payables for $300, right? And the balance is going to be the amount that's paid, so the $7,700. So when you pay in full, that amount comes off the books, all right? $7,700, all right? But we're inside the discount period, so we want to be hesitant to just credit cash, because a check cut is not going to be for $7,700 since we are inside the discount period. Right. We know there will be a discount here. We need to calculate it, and on the book for the purchaser, the discount goes to a reduction in inventory balance because it reduces the overall cost paid for inventory. We're going to have a credit to inventory and a credit to cash. Let's calculate the amount. Alright. The terms are 210 net 30, which means a 2% discount on the net amount, so less return, so 7,700 times 0.06. Alright. Which works out to $154. And we can plug the cash. That makes the entry balance. So 7,700 less than 154. I'll show my formula there. And that's all part A asked for. We journalized the transactions for the purchase of inventory. So why don't we go ahead and shift gears into part B. Now, here we're going to do the same transactions on the books of Epps Company. Alright. So we'll start with the June 10th transaction. Tunes and Company purchased $8,000 of merchandise from Epps Company. Alright. So this is a revenue transaction, not a cash transaction, so the debit goes to accounts receivable. Credit goes to sales. sales revenue. There we go. Alright. But, and this is one thing, it's easy to forget, there's another entry, because we also need to report cost of goods sold expense. Right? On the books of the seller, there's a second entry. Right? Cost of goods sold expense. I may in the future abbreviate that COGS, cost of goods sold, but for the time being we'll write it out. And what did they sell? They sold inventory. Right, and the instructions actually gave us the relevant cost. So that cost the company $4,800. Okay. Now, with those two entries, we've taken care of the sale on June 10th for Epps Company. And the 11th, Toombs and Pace freight costs. We don't have to pay attention to that. It doesn't relate to the seller. Those freight costs will be paid directly to the shipper. So we'll jump to the 12th. On June 12th, there's the return. So June 12th, damaged goods totaling $300 are returned to Epps for credit. Alright. Fair value of these goods is $70. Alright. So just like we have two entries to report sale in a perpetual inventory system, we're going to have two entries to report the return. Alright. One thing to remember is we don't want to debit sales revenue. We use a contra revenue account. Sales returns and allowances. Alright. With the credit going to accounts receivable. With the inventory return, the company won't be paid, won't collect on the $300 in account, so we reduce that. Alright? The second part is at cost or fair value, and the fair value information is given as $70. Alright? So the company is getting inventory back that has a fair valuation of $70. So presumably that could be sold as damaged or second quality inventory for $70. We're going to reduce. Well, let's start with what the company's getting back. They're getting back inventory worth $70. Sell inventory solution. So they're getting back inventory worth $70, and we want to credit or reduce the cost of goods sold. Okay. So that's $70. It costs $70 less than. We want to reduce cost of goods sold since our $70. Right? So that's the June 12th transaction on the books of the seller. Alright? And the last transaction we have, the 19th, Toombs and Pace Epps Company in full. That's the purchase discount. Okay. So here's one other point of confusion. On the purchase side, in their discount, we credit inventory. On the seller side, when discounts are taken, you use what we're going to refer to as a sales discount account. Okay, so since we've already journalized this transaction from the buyer's perspective, we already know the amount of cash that's coming in. Alright, it's going to be our $74.56. Alright, there is going to be a sales discount, which is a contra revenue account, so we're going to debit that. And that's going to be, we've already calculated that as well. It's going to be for the 154. Alright. And then the only other thing left to do is take the receivable off the book with the credit. In the amount of $7,700. Okay. This is E5-4. It gives us exposure to both the purchase of inventory on merchandise transactions and the sale and how to journalize for both. This is going to be some of the heavy lifting for this chapter. We want to understand both, and not only understand both, understand when to use which. Alright? Okay, now we're back to talk about the fifth learning objective in this chapter, which is our multi-step income statement, our multiple step income statement. So you may recall in chapter 1 we learned how to do the basic income statement. Alright. So this is an evolution of that. And a multiple step income statement is commonly used by merchandisers or companies that sell inventory. That is their business, and it provides more detailed information of costs. Mainly, it separates inventory-related costs from operating costs. All right. So we're going to take a look at that. Okay, so again, this is just an illustration out of the book. And if we start at the very top and the very bottom, we see headings the same. So a heading of multiple step income statement would actually be incorrect. The heading does not change. And if we jump all the way down to the bottom, we also see net income. All right. So we're still getting to net income. It just looks different in the middle. It also still starts with revenue. Alright. So we have sales. Starts with sales. And we see net sales. So sales would be gross. Returns and allowances we've journalized for. So we know what that is. And sales discounts are for when companies who offer discounts for early payment. Alright? So those things are reductions to total revenue. Cost of goods sold, which is a term we should be familiar with by now. That's an expense. Cost of goods sold is all inventory related expenses. Alright? Gross profit. Alright, if you're asked to do a multi-step income statement, you must show gross profit. And gross profit is exactly net sales less cost of goods sold. Alright, in this case, $144,000. The operating expenses section is very similar to the expenses section that we would have done in chapter 1. And effectively, it's all other expenses with the exception of cost of goods sold. Right. So So typical things you see here. Um, in this case, Collins, 114,000, giving us income from operations. In most of our multi-step income statements, that will be it. That will be it for us. We also may, there are a few examples in the book where we have other revenues and gains, or other expenses and losses. And then we have other revenues and gains, other expenses and losses. This is a way to separate non-operational transactions and expenses and revenues related from those from operational revenues and expenses. And you see the types of things here. We see an interest revenue. In this case, PW Audio had $3,000 worth of interest revenue. Well, that's a non-operational revenue because PW Audio is not in the business of lending money for interest. That's why we separate that as a non-routine transaction because it's not what the company is in business to do. And we've got gain on disposal, which we'll get to in later chapters what that actually is. But we'll nutshell it. That's a sale of depreciable assets. Again, so that's non-operational because if you get a gain from that, it's going to affect net income, but it's not going to be something that you can rely on every year. So for investors' sake, those things are commonly reported as other revenues and gains, or sometimes non-operational revenues and gains. And then the other expenses and losses, we see interest expense, casualty loss from vandalism, you may see casualty loss from fire, natural disaster, or what have you. Those are things that cost the company money but shouldn't happen every period or every accounting period. So we separate those. If I'm an investor looking at the income statement, my thought process would be that these should be fairly non-routine transactions. So that's our multi-step income statement. We're going to take a look. We're going to work through the creation of one in just a moment. Okay, so now we're going to take a look at the creation of our multi-step income statement. And in doing so, we're going to use exercise E5-9. Okay, so in E5-9, this is on page 259 in the text. The instructions are to prepare a multi-step income statement and to compute the gross profit rate. Okay, and we're given several accounts to do this. So let's just start. Nothing has changed with the heading, so we'll start with the heading. We're given information for Furlough Company for the month of March 2015. So heading is identical to the heading that we would do from chapter 1. All right, or I should say the headings that we did in chapter 1. Let me try it again. Alright, and the heading is income statement, not multi-step income statement. And for the month ended. All right. Okay. So we'll start with revenue. And as a matter of fact, we'll label this section sales since we are dealing with a merchandiser. And sales, that's stylistic. Sales or revenue, either one of those would be fine as the heading there. Alright, so we start with sales revenue, and here it's listed $380,000. But keep in mind we have to back out sales returns and allowances and sales discounts. So we'll do that. We've got returns and allowances of $13,000 and discounts of $8,000. Giving us net sales as the difference between the two. $359,000. The next thing we want to pull off is cost of goods sold. This is giving us $212,000. $147,000. That's what we're going to label gross profit. Now, gross profit is an important number on the multi-step income statement, and it's important because it is revenues less inventory-related costs or merchandise-related costs, which is an important number to know. The multi-step income statement separates operational expenses from inventory and merchandise-related expenses. Another way to think about gross profit is it is the amount that's left over after you have paid for the inventory sold. Let me restate that. It's the amount that's left over after inventory costs to cover operational expenses and to provide for net income. So if you know gross profit and you know total operational expenses, if gross profit is bigger, you've got income. If gross profit is smaller than total operational expenses, you've got a net loss. Alright? Okay, so next we want to get a total for operational expenses. And actually, to be consistent with the text, I use operating. Alright. And then Typically, we would pull these in order of magnitude, so we'll go with salary. Rent expense. Freight out. So that freight out would represent shipping paid for by the seller. Alright. So freight out is an operational expense. And insurance. Alright, we get total operating expenses. And at this point, we can calculate net income. Which is going to be gross profit less total operating expense, 144,000. We'll take a double line under that. Alright, so that's requirement A. We've done our multi-step income statement. Alright. The example in the text also had other non-operational expenses. There were none in this problem. In class, we'll work through one or two that have non-operational expenses, but that won't be present in every problem that we have. So this is your basic multi-step income statement that we should be prepared to produce. All right. Part B asks for the gross profit rate, and this is just a ratio. All right, which is gross profit divided by net sales. All right, I'll write that out. So, in other words, for this problem, it looks like this. 147,000 divided by 359,000. Right? And so we get 0.4. Let's take that as a percentage. Increase the decimal. 0.495. Accurate to 2 decimal places. What does that tell us? Well, here's the first. It tells us when we're having trouble selling profit. But besides that, well, it tells us for every dollar in net sales, 40 cents, almost 41 cents, is gross profit. So you could think about it a couple of ways. If $1 revenue, if $1 net sales is generated, almost 41 cents of that dollar is left to cover operating expenses and provide for net income. That's one way to think about it. Another way to think about that gross profit percentage is that if we take the opposite of that amount, so 59, just under, almost 59.05%. So if we take 1 minus the gross profit, that means 59% of each dollar of net sales goes to cover inventory or merchandise related costs as cost of goods sold. Right? Simply dividing this by this, so the 212,000, if we divide it by this, will come out to 59.05. And that tells us that of every dollar of net sales, 59 cents of that goes to cover inventory related costs. So that's the value of the gross profit rate. It's an analytical tool that can be used to show how much of net sales is going to inventory costs versus operational costs. And as you can imagine, that varies drastically from industry to industry. In some industries, it's very high, whereas most costs are operational. In some other industries, it's very low, whereas operational expenses are much smaller in comparison to cost of goods sold. Okay, so that's an analytical tool. You'll have a lot more use for those in 225, your next course, but we're getting some exposure to them now. Okay, so the heavy lifting for this chapter, obviously we want to understand the foundational concept, and we want to journalize the purchase of merchandise or inventory transactions. We need to be able to understand that. We also need to be able to understand and journalize the sale of inventory and merchandise. Alright? And we need to understand the difference between those two. And we want to practice enough so that we don't get confused. The other heavy lesson for the chapter is the multi-step income statement. So this is an evolution of our chapter 1 understanding of the income statement. It is commonly used by merchandisers, retailers, wholesalers. So we want to be comfortable with the creation of that. And that's the heavy lifting for chapter 5. We'll spend some more time practicing this in class. Since I did an e-lecture, we'll spend a little more time. We'll work through some problems. We'll do some group work in class. There's chapter 5.